Welcome to Optiontiger.com. My name is Harry Swaminathan, and this is the options education playlist on YouTube. And what I want to do is just take small little topics and just drill down a little bit. So one of the first things that option traders have to understand when they first enter the options is, how is it different from stocks? So in stocks, as you know, let's just take an example. I've taken Caterpillar here. So here's Caterpillar. Let's say if you wanted to buy Caterpillar, and let's say if you wanted to buy 100 shares of Caterpillar, you have, its price. Obviously, you can choose the mid price, give it a little bit less, mid between the bid and the ask. But if you wanted to buy 100 shares at $83, the first thing you're going to see is that you're going to pay 8,397 plus some commissions, all of that. Now, if you have a margin account, your buying power effect is 50% for stocks. Okay, so that's one thing, but that's only if you have a margin account. If you have a cash account, then you have to pay the entire $8,400. So now, if you did that, let's just compare it with options. In the options world, you have what you called at the money options. And of course, there's a bit more of education involved in all of this. I'm just trying to cover a basic topic. And the first thing you'll realize in options is that you have option series for various points in time in the future. And that's exactly what options are. Each of these represent an options expiry series. So let's say we went into the December with 78 days. Here you can buy the same 100 shares. It's not actually shares. It's only, it's what you call as contracts. But one contract in the options world is equivalent to 100 shares. So if you wanted to buy one contract of an at the money option, you would pay approximately $2.54 for per share for that. So if we wanted to create an order, that's exactly, you can try to get a lower price in the middle. And if you see this, the cost of this is $253. So the first thing you have to realize that options are a very inexpensive way of playing the same game. So you're putting $253 here, whereas if you bought Caterpillar, the stock itself, you would pay anywhere from either $4,000 if you had a margin account or $8,000 if you had a cash account. So clearly this is an advantage, and obviously it comes with a few disadvantages. One of the things is this is a December series, so this option will expire in December. So what does that mean? And there's a lot of meaning to that. The value of this option is going to reduce if Caterpillar doesn't make a move to the upside, because when you buy a call option, it's just like buying stock. You're bullish on the instrument. So, but as you can see, the point of this video was to show you in terms of capital usage, options can be very, it can be, your margin or your cash requirement can be significantly reduced. And the good thing with buying a call option or buying a put option, either one, if you're a buyer of options, the maximum you can lose is 254. So if you take a look at this option, that's it. So, the maximum you can lose is this number in red right here. So it doesn't matter if Caterpillar crashes to zero, your maximum loss is 254. So that's a fantastic feature of options. Anyway, so this is just to cover this basic aspect. One is, how options can be very cost effective, and two, when you buy options, your losses are limited. There are, of course, lots of pieces to options. It's a three-dimensional instrument. So you have the price, you have time and time decay, and you have the volatility. All of that features into options, but this is just a small topic here. Thank you.